let me give you a brief introduction to our presenter today, Mr. Adel Merheb. Adel is a seasoned financial professional with a decade-long experience in regional GCC and global financial markets. He's the founder of TradeYourMarket.com, a newly established trading advisory business that focuses on the GCC equity markets. Prior to founding TradeYourMarket.com, Adel was Vice President of Investment Research and Chief Technical Analyst at Shua Capital, a leading publicly listed investment bank in Dubai. Adel has also assumed various investment roles throughout his banking career, working alongside the investment banking and treasury teams at the largest private commercial bank in Dubai. He's the author of many research publications covering the MENA, equity markets. He's also acted as portfolio advisor to various institutions, funds, and high net worth individuals in the GCC region. His ability to consistently be on the right side of the market has earned him the reputation of a top analyst among a growing list of followers. Adel is affiliated with the Market Technician Association as well as the CFA Institute, and holds a degree in business and finance from the American University of Beirut, graduating top of his class with a merit of distinction. So we're really pleased to have him with us. And I'll go ahead and turn over the time to Adel now.
Thank you, Dave, for the introduction, and I'd like to take this opportunity to thank Thomson Reuters for making this happen. My name is Adel, and as Dave mentioned, I'm the founder of TradeYourMarket.com. We're an online trading advisory service, and we focus on the equity markets in the Arabian Gulf. I'm a technical analyst by profession and a trader by passion. I started my career as an analyst for a hedge fund that used to trade US equity options. But over the past 5 to 6 years, I've been focusing on MENA equity markets and specifically the GCC. Alright, so basically we're going to be covering two parts in the presentation. The first part is an introduction to the GCC equity markets. We're going to talk about things such as size, accessibility, and market participants. And then we're going to discuss why we think this is a good time to start tracking GCC equity markets, if not trading them. In the second part of the presentation, we're going to delve into the trading side of the business and looking at charts and comparing charts in the region. Some of the points we're going to be discussing are the link between GCC equities and global markets, market rotation and lead-lag relationships, the importance of investment flows and reading the price action, and last but not least, we'll talk about some trade profiles that offer the highest reward potential and some of the best success rates. Moving on, we'll start with the scope of the presentation. Just as a start, let me define GCC. Whenever we refer to the term, we mean Gulf Cooperation Council, and that includes countries like Saudi Arabia, United Arab Emirates, Qatar, Kuwait, Bahrain, and Oman. Now, for the sake of this presentation, our focus is going to be on Saudi Arabia, which is the largest market in the region, but we'll also discuss UAE and Qatar. So we'll start with size. Saudi trades a rough average of $1.5 to $2 billion a day. By far, this is the largest market in the region. This may seem a small or insignificant number for those who might be tracking US or European markets, but given the size of the region, we think this is a decent market to trade. UAE and Qatar, of course, are much smaller, with a daily average of $70 to $120 million. These figures used to be much higher before the crisis, but we've had a severe drop in liquidity post-2008. But again, the interesting part in the story is, the fact that we're moving from a low base gives you a huge potential for growth over the coming years. On the accessibility front, Saudi is the least accessible market in the region, though it's the largest. Effectively, it's only open to local and GCC nationals. Now, indirect access is available, and it's granted to international investors through total return swaps and P-notes. Now, for those of you who don't know, these are structured instruments that allow you to get indirect access to a certain market. So effectively, you don't outright own the stocks, but you have a third party that buys them on your behalf, and the exposure is yours. So whatever happens to the stock is effectively, will be reflected on your position. So that's why you can get the exposure, but you don't have direct ownership. Now, UAE and Qatar, on the other hand, are open markets, but they have restrictions on the level of foreign ownership allowed in local stocks. UAE typically has the limit set at 49%, so most of the stocks are available to foreign investors, but the limit is capped. And in Qatar, it's a similar story, but the limit is lower and it typically hovers around 25%. So again, it's a mix there. So we have Saudi, which is pretty much closed in terms of direct access, and UAE and Qatar more open. But as we discussed shortly, we think the direction is towards more opening of these markets, and we'll talk about that in a minute. Moving on, in terms of depth, Saudi has over 100 actively traded stocks. Again, this may seem as insignificant when you're looking at some of the bigger markets in the world, but it's a decent size for this region. UAE and Qatar are much smaller. We're talking anywhere between 10 to 15 actively traded stocks. Again, that was due to the fact that, post the crisis, post 2008, we've had a sharp drop in liquidity, and a lot of the stocks that used to be liquid before are now sort of tricky to get into because exiting these stocks is an issue at some times when liquidity dries up. So on the structure side, and this is a very important point to highlight, we're dealing with a long-only market in the region. So shorting is not permitted, at least not until very recently, and it's only in one of the markets. Again, we'll discuss that shortly. But effectively, most of the funds and most of the investors and traders that track and trade the region, basically, they are long biased. It's hard to go short, at least not legally. So another important point here to highlight is the fact that the markets are very much retail driven. Unlike what we see in Europe and in the US, where the bulk of the activity is driven by pension funds and institutions and companies and mutual funds and so on, we've got, for example, in Saudi, over 90% of the traded value coming from retail and high net worth individuals, and that ratio effectively drops to around 60% for Qatar and UAE. Despite the drop, the number is quite significant and high. So that tells you how different the dynamics are here for this region when it comes to sort of the drivers behind the market. On the classification side, it's important to note that even though we keep referring to the GCC as emerging market, the actual classification is frontier market. And by frontier, you can think of that as a third tier in terms of ranking. So effectively, we've got the developed market status, we've got emerging market status, and then we have the frontier markets, of which GCC form part. And this may seem as a drawback, but again, as we explained very shortly, this could also be or prove to be a big opportunity for the market going forward. Now, having covered a very quick intro, let's now touch on why we think this is a good time to track GCC and why the future could be very positive for the markets in the region. Point number one I want to talk about is the growth potential and the high growth that we're currently witnessing. As you all know, in today's world, developed markets are really struggling to avoid recessions or at best maintain some level of economic growth. And in that kind of environment, you have a region that presents some of the fastest growing economies in the world. So we've got estimates for GCC growth for 2013 that are anywhere between 4.5% to 6%, and these figures are expected to stay strong thereafter. So a very interesting story on the growth side of the GCC market. Another important point here is the fact that these markets are really trying to open up. The process might be slow, but they're definitely moving in the right direction. As we mentioned, access or direct access is currently limited in Saudi. It opened up in 2009 to foreigners, so that was the first positive move. So from being completely closed out to opening up via total return swaps and P notes. And there are huge expectations these days that in 2013 the Saudi market will open up to direct ownership, and we think this is going to be a huge boost to the liquidity and to the price action. Qatar and UAE both are open, but then we've highlighted the fact that their ownership limit is capped. So Qatar is expected to increase the ownership level available to foreign investors, and possibly UAE might even consider increasing beyond the 49% for some of the stocks, maybe not the entire market. So these are very important points that will help improve the markets or drive the liquidity and prices up over the coming months and years. Another point to highlight is the deregulation. There are real efforts to deregulate and develop the markets in the region. For example, recently, the Securities and Exchange Authority in the UAE has issued a rule that allows securities lending and shorting along with market making capabilities. Now, this is extremely important. As we mentioned earlier, these are long-only markets, and up until recently, UAE now is the only market that is allowing securities lending and shorting, and we think other markets are going to follow. So as you can see, there are real efforts to try and develop the markets here, the equity markets at least. It may be slow, but it's definitely moving in the right direction. Last but not least, on this side is the potential for upgrade. Again, we talked about the fact that these markets are classified as frontier markets. And while this may seem as a drawback, given that it's at the bottom of the spectrum of classification, the upside potential that could unfold upon a possible upgrade to emerging market status is huge. Effectively, the way it works is whenever a market gets upgraded, for example, from frontier to emerging and from emerging to developed, it gets included in certain indices, and these indices are tracked by passively managed funds. And every time an index is included in a benchmark, such as the MSCI, the Morgan Stanley Composite Index, for example, you've got by default flows or exposure coming from these passively managed funds. So that is a huge boost to liquidity, and in turn, that will be a huge boost to the prices of these markets. We expect UAE and Qatar, in fact, there's a huge expectation in the market that UAE and Qatar could be upgraded by next year. In fact, we think one of the reasons why the SEA, the Securities and Exchange Authority in the UAE, recently issued that rule that allows shorting was because they wanted to make sure or guarantee that they get upgraded to emerging market status. So again, this is going to be very positive for the markets. With that, we conclude the first aspect of the presentation, the intro to the GCC. And again, I think you can tell from some of these points that we've gone through that the growth potential is definitely there. There might be some drawbacks at this point in time. Liquidity in some of the stocks might be an issue. The fact that the size of the market is small, the fact that the IPO market has been sort of fairly weak, so we haven't had a lot of new listings. But we think there's a big potential over the coming years for growth, and we think this is a very good time to put these markets on your radar. Now let's move on to the second part of the presentation. Probably this is more interesting because we're going to be dealing with charts and making some comparisons. And we'll start with point number one, which is the link between markets in the GCC and global markets. Now, the two main points I really want to get across here are, the relationship between the micro and the macro. By micro, we're referring to the specifics of a certain market or specifics of a certain region, for example. And by macro, we're looking at the context of things. So, for example, when we look at Saudi as a market on its own, we typically look at the specifics of that market, but we always look into how these specifics sort of play out within a broader context of or a contextual macro view. So, and here what we're trying to show you is the relationship that the markets in the GCC have with the global indices, and of course here we're using the S&P 500 as a reference, given that it's the leading market in the world, and effectively it decides the direction of a lot of the markets across the globe. So here in the first half chart that you see, we're showing the very tight relationship that we've had in 2008, so during the crash, and then the following bounce that took place in 2009. Now, one could argue that this was effectively a common scenario or a common pattern that we've seen across almost any market during those 2 years. But what we want to show is yes, it's true, but that tight relationship actually holds at other times, even at times when you're not in a crisis mode. And here you can see basically the second half, which is 2010, 2011, 2012, if you like, and you can see some decoupling periods and some high positive correlation periods. So let's very quickly go through this chart. And we've had the sell-off in 2008, the bounce in 2009 up until early 2010. And then we had almost a year of disconnect from mid-2010 to mid-2011, back seeing a recoupling in the market. So again, the Saudi index was moving alongside the S&P 500. And very recently, over the last few months, we've seen another divergence in performance. Now, we can delve into this and try to understand why this happened. And actually, one of the interesting things when you're looking at an index or at the market in a contextual view is you get a better idea of how you want to play whenever you get a divergence. So, for example, if you look at Saudi in the first decoupling phase between June of 2011 until the first half of June of 2010 until the first half of 2011. You could see that the S&P was rallying, and at that time, if you recall, it was on the hopes of the QE2 and the expectations for QE2. We couldn't see a catch-up rally by the TASI, which is a Saudi index, in the second half of 2010, even though the market was really sort of prepared for that. The beginning of 2011, we've seen sort of a sharp, quick crash, if you like, in Saudi, and again, if you recall, that was due to the Arab Spring and what was going on at that point in time. Saudi wasn't really or directly affected, and that's why I've seen a quick bounce from there. But still, the market was not able to follow, after this bounce and catch up to what was going on in the U.S. And then we had the market again here, sort of fall back down. And then we saw a recoupling phase in late 2011. And again here, if we want to look at the details and why this has happened, we had anticipation of a QE3, and we've actually had the QE3 kicking in here for the US, and then a failure for the Saudi index to follow. There were very micro-specific reasons of why Saudi couldn't rally alongside the US or as much as the US did. And those were the fact that there was some expectation that the numbers for the last quarter, the earnings number for the last quarter, are going to be disappointing, and indeed they were. So the market failed to read. So again, this is a potential play. For example, whenever you see this kind of divergence, and you wonder, are we going to see Saudi catch up? Once we get some stability around these levels. And of course, that all depends on whether or not the S&P is able to hold its territory. So very interesting plays. And again, the key points that we want to mention here is looking at the micro or the specifics of the market in the context of what goes on globally. You'd think that for markets like the GCC, they're very far from the US, or that have economies with completely different dynamics. They would tend to be very much disconnected, but they're not in almost 60 or 70% of the time. So that's a very important point to highlight. Moving on and sort of trying to emphasize on that point, we show another chart here And it's effectively, I mean, we're making the same argument. This is a chart that compares the S&P 500 with the Qatari market and the Qatari index. And here you could see the same thing, extended periods of positive or high positive correlation and periods where you have decoupling. This was a small initial period in late 2009, 2010, and then we've had an extended period of decoupling over the past year or so. And interestingly, it's again, you get the same relationship, like we've seen in Saudi, but in a different way. So, for example, in Saudi in 2010, it was moving sideways, while Qatar was actually rallying alongside the S&P 500, and there were reasons behind that. At that time, the Qatari market or the Qatari government was very sort of proactive in helping its banking system, and they were recapitalizing the banks, and that gave a boost to investor sentiment. So we did see a continuation of that high correlation with the S&P, just like we had QE2 here. We had a strong support for the banking system in Qatar. Now, the interesting part is very recently what happened is effectively over the past year and a half, or less than that, we had the S&P rallying to new highs and Qatar just moving sideways. I'm not sure what the reasons are for that. We seem to have reached some sort of buying exhaustion. But again, it's very interesting to look into it because, and this is why I'm saying the contextual view is very important, because based on this divergence, we can come up with a lot of potential scenarios of why this is happening or what we could potentially see going forward. So is this a time to actually bet that we're going to see a catch-up play, or is this some sort of a top? We've diverged and we're seeing some sort of a top formation in Qatar. I think that all depends on how you view the S&P. We tend to believe that the S&P is making or has made a short to medium term top. So even though we're somewhat positive on the micro side of things for Qatar, the macro picture is not as attractive in our view, and so we tend to be more conservative. So again, this is how this helps you look into these markets. Another chart here, and we're looking at the Dubai index. And the reason why I wanted to show this chart is to give you another example of how you could have three different markets within a region that is very much sort of involved in the same dynamics, but then have three different, completely different charts for these markets. So here, Dubai, the Dubai index completely diverged since late 2009. And of course, it goes without saying, there were major issues in terms of very high debt levels, and there was fear that private companies, along with potentially listed companies, would go bankrupt, and so on and so forth. But the interesting part is, despite the fact of having this market completely diverge and have completely different dynamics due to some of the issues that they were facing, and the fact that eventually Dubai is an emirate and part of a country, so it's not up to them to print currencies or to issue debt. It was up to the capital, Abu Dhabi, and the relationship there was not very clear in terms of how they're going to help and who. It was the transparency there was not very clear at the beginning of the crisis, and right when things started deteriorating for these markets. So, despite all that, you get those periods between the decoupling phases where the correlation is again high. And here, when I say correlation, I'm not saying in terms of performance. By the way, it's important to note that we're talking about correlation of direction. So a market can go down by 5%, and another market would go down by 2% maybe. So in terms of performance, it doesn't have to be the same, but in terms of direction, it is the same, and that's what's important. If we look, for example, from the bottom of 2009 until today, we've got probably 100% return for the S&P. Qatar probably gave you somewhere along the lines of 90-95%. We had a 70% rally in Saudi, and I think tops we had a 12 to 20% rally in the Dubai index. So you could see there was major differences in terms of performance for these markets since the bottom after the crisis. But in terms of direction, throughout the move over the past 4 or 5 years, you could clearly see that correlation kicking in so many times and for extended periods of time. In fact, we think it sort of that high correlation in direction is around 60 to 70% of the times. Now, the last chart I want to highlight on this point is the Saudi petrochemical stock, which is it's SABIC, and it's the largest petrochemical stock listed in Saudi, versus the oil price. And we're looking at Brent here because it's the proxy for the oil that comes out of the region. And this is, again, just, the chart speaks for itself. The tight relationship is extremely obvious here. The decoupling periods were very small and actually played out as perfect trade profiles. So, for example, in late 2010, early 2011, we had oil prices really shooting up, but then SABIC failed to react. And what happened is later on we saw SABIC catch up to the rally. So again, in these times when you get these kind of divergences, you ask yourself what's going on. And when you have sort of a 90% period of high correlation and you get a period of negative correlation, then you start wondering whether this could potentially prove to be an excellent trading opportunity. This is a question that one could ask even in recent days. Here we've seen oil prices bounce strongly, but SABIC failing to do so. And again, that was an earnings-related issue. Even though the numbers here came out almost in line, our investors were not very enthusiastic about the numbers, and we saw a flat performance. So one could easily argue that because of that, and if oil prices maintain their levels over the coming weeks, we could easily see a catch-up play by SABIC. So again, this is the interesting part when you look at a market in a contextual view. It just gives you this additional element of understanding or confirmation, if you like. Now, moving from the linked with global markets to the rotation and lead-lag relationships, I just want to again emphasize the fact that these markets are retail-driven, and that retail nature implies a greater level of herd mentality. So typically what you see is a rally in one stock from sector A, for example, will trigger a move by other stocks in the same sector with a lag that varies with the level of excitement in the market. So this is very interesting for any trader, because a lot of the times you see a stock make a move and you wonder whether or not this is the move, or whether or not it's a move, it's a proper move, or it's a fake out. So, for example, here we show three different stocks, as you can see, three different charts. And the first chart, so the black chart here, you could see the stock breaking out at this point. I've laid out a vertical line here so that you can see. So we saw a breakout. It's a very clear breakout from this range. But then if you look at stock number 2 and stock number 3, the green and blue charts, you don't see a similar reaction, at least not for stock number 2. We did see a strong bounce in stock number 3, but the fact that it's been underperforming the first two stocks, it wasn't really a breakout. But then what happened is, if you look at the second chart, or the green chart here, the breakout took place almost a week later. And in the case of the third chart, the breakout took place almost 3 weeks after that. Now, the interesting part about this pattern, and it's a very common pattern that we see in the region, is the fact that, if you were skeptical about the first trade, when you see that kind of move, if you wanted to get in after that breakout and you were wondering whether it's a false breakout, and your risk-reward ratio is probably not ideal here, because, you would have had to place it slightly, at the pre-breakout level or even lower. Now, the interesting thing here is you tend to play, if you tend to play the lagging stock, you're probably better off, because this stock did not move. It's giving you a much higher reward potential for much less risk. So, and in the case of the third stock, it's probably the same. So what I want to mention is the fact that, that you have this herd mentality, that once you see a stock in a certain sector make a move, other stocks will typically follow. And it gives you enough time to get into the lagging stocks. That's really, if you want, a huge opportunity when trading these markets. It really gives you enough time to get in. I think in a lot of the other markets, you don't see that kind of lag, or the lag is much shorter. So here, it's very common to see extended period of time where a stock makes a move, and then a few days later or a week later, you see it follow through by other stocks in the sector. A very, very important relationship to highlight. Again, this is another example, and here we just wanted to stress the fact that It doesn't have to be stocks within a sector, but it can actually be stocks in, across different sectors. So here again, we're showing three different charts. The second and third pertain to the same sector. The first one is a different sector, as you can see. The chart at the bottom shows you a stock that made a move. It was a very strong move that lasted for about 3 weeks. But then we've had almost like a muted reaction by the second stock and the first one. But eventually, what happened is those stocks actually caught up to the rally. So again, that's another example where you get enough time to get in following an initial mover, which is here. In this case, it's the third stock at the bottom. So that was the first mover. You didn't want to play the stock for whatever reason because you were worried that your risk-reward potential now is going against you as the stock moves up. You can easily get into some of the lagging stocks. And here, I do want to mention that yes, probably the first mover is the strongest, when you look at the entire move. But the benefit that you get from not being exposed to the downside risk is extremely important in our view. And the way we look at it is if we can get 70% or 80% of a move in a certain direction, then we're more than happy. We're not looking always to capture the top gainers. So just trying to capture the direction as much as we can. And we try to do that with minimum risk by looking at those laggards. So again, very important relationships that are very common across the markets in the GCC. Moving on, we'll discuss here the importance of investment flows, and we can't stress this enough. We think the study of investment flows, of the daily investment flows, is extremely important to understanding the markets and the direction in the market. After all, it's all about supply and demand, who's selling and who's buying. And if you have data that actually tells you or shows you the categories of investors that are buying or selling on a daily basis, then you probably have an edge engaging market direction. So here what we show is we're showing the Dubai index, and what we show is that since 2009, so we're looking roughly at a 4-year period, we've had 13 legs in the market, the way we've laid them out. And as you can see, we've had up legs and down legs, and those green up legs, those reflect net foreign buying and net local selling. So during that time of the rally, we looked at the data, the investment flow data, and we found out that the net of the buying and selling of the foreigners, was positive. So it was net buying for the foreigners during the rallies, and it was net local selling during the rallies. And during the sell-offs, it was net local buying and net foreign selling. So effectively, over the past 4 years, from those 13 waves that we've identified, 11 waves were technically driven by the actions of the foreigners. And an interesting point to highlight here is that foreigners actually are only 20 to 30% of the value traded. So you've got the retail side, which controls 70% of the liquidity in the market, and you've got the foreign side, you've got the local side, which controls, because usually the retail side is the local side. So you've got the local side controlling almost 60% to 70% of the value traded in Dubai, for example, and you have 20 to 30% being controlled by foreigners. But those 20 to 30% qualify as the smart money. They're the ones driving the direction on a net basis. So out of the 13 waves, we have 11 waves that are determined by the actions of foreigners. And the interesting part here is that, if you look at those 2 waves, waves 11 and waves 12, you could see sort of a change in trend. So effectively, wave 11 was the first wave where locals were actually driving the trend, and it was the locals in wave 12 that drove the sell-off. And that raises a question, or a flag, if you like, on whether or not we're seeing a shift in dynamics, and that's why we're saying this is extremely important. So when we're looking, for example, in early 2012 at the rally that was taking place, we're looking at the data and we're seeing that it was driven by the locals, and then we thought, okay, we should not trust this rally because it's not the smart money that is driving it, and we did effectively exit maybe at midpoint of that. So it really makes you wonder. You might miss the first move, but then it makes you wonder whether or not this is a change of trend or just a one-off exception. So bottom line is extremely important to look at the investment flows. Eventually, supply and demand is what drives the market, and if you can overlay that to your study of the charts, it really gives you an advantage in reading the price action in the market. Now, finally, we want to talk about some of the best trade profiles, some of the trade profiles that we think offer the highest success rates and the highest reward potential. And we'll start with the catch-up play. The catch-up play is very similar to what we were discussing, on the lead-lag relationship in the market. And as we said earlier, it's usually hard to anticipate a rally in the first mover within a certain sector, but then the market allows you, enough time or gives you enough time to play the usual catch-up by the other stocks in the sector. And here again, we show 3 stocks from the same sector, and we show the one at the bottom making a move, while the first and second just, still being stuck in sideways behavior. But then the first and second catch up 4 or 5 days after the third stock makes its move. So you've got this period where this stock moves, and then following after we cross this line, you get a catch up. So again, very interesting because it gives you enough time to play the laggards while being exposed to the least risk possible. So here, if you look at the latter part of this, you saw the first stock making a move, and then these 2 stocks being stuck. And that's the interesting thing, is if you look at the last stock here at the bottom, we just saw the catch-up taking place. We still haven't seen anything in the second stock, so this could potentially also prove out to be a very interesting play. So again, very important profile that we focus on, and the beauty of it is that it's very common. We tend to come across these profiles a lot, when we screen the market. The second profile we look at is the capitulation trade. Basically, regional stocks tend to exhibit extended bottoming processes, and that gives, again, ample time for an entry. Now, the bottom doesn't have to take months or weeks, and it actually happens in so many different time frames, but they do tend to have this process of bottoming rather than a V-shaped rebound. So in a V-shaped rebound, it's very hard to capture a move, because you're waiting for confirmation and you don't get it. But then, in those stocks or in markets where sideways or a range-bound behavior is common in between trends, it's amazing because it really allows you to sort of work your trade and get enough confirmation to play it. So here, this is a very interesting stock where we had a downtrend and then we shifted to a nice bottoming formation, and that gave you a long time to actually act on your trade while keeping your downside to a minimum. So almost any point that you would have entered here would have been a good point to buy in terms of risk reward, and then we had a very strong rally thereafter. This is another example, and again to show how these come in different shapes and time frames. Here we have basically we're highlighting 2 small bottoming formations, if you like. Again, there was enough time, it wasn't a V-shaped rebound. Even if you look at the smaller other ones, the ones that we're not highlighting, even here, it's not a typical V-shape where you get a sharp sell-off and then a sharp rebound that makes you miss that nice pick at the bottom. It's very nice. You get really good, interesting points across so many different stocks across the GCC markets. Now, finally, one of the plays that we look into is also the dividend play. This is not something we super focus on, but it is an interesting play at times. What I want to mention here is that it's common behavior among traders to buy a stock ahead of a dividend date. It is counterintuitive, but the moves are fairly predictable. So as you can see here, we've highlighted the 3 different dividend record dates, and as you can see, the 2 weeks heading into that date, we always tend to see an upward bias. Again, it is counterintuitive given the fact that post the dividend the stock does adjust for whatever the dividend was. But it does work out. This trade does work out more often than not. So So basically, that's our last profile that we tend to look into. With that, basically we finished the presentation, and I just want to
thank you to all of you who were able to join us this morning here. And Adel, thank you for a very fine presentation.
Thanks for having me, and thank you everybody for attending. And feel free to just check the site and send me any questions. You'll see some of our sort of addresses there if you need anything. Thanks.